We are over 2 months into 2026, and the stock market has hardly changed from where it started the year. The Nasdaq is down, the S&P is flat. Tech stocks, the same names that carried the entire market 2023, 2024, and 2025 are getting hit hard. Nvidia's down, Microsoft down, Palantir down. And the financial sector, which was supposed to be a bright spot, recently took a nosedive. You have to be asking the question, how do I make sense of all this noise? Now, here's what's really been on my mind as of late. You have a large number of investors rushing out of those names and cycling into consumer staples and healthcare, these so-called safe havens. Coca-Cola's up, Procter & Gamble's up, Costco is up. People are behaving like we're on the edge of something terrible. So today, I want to talk with you about what's actually going on. What is really driving all of this? Is the fear rational? Because it rarely is. And most importantly, what should a disciplined long-term investor actually be doing right now? Because here's the thing. The investors who build real wealth, they're not the ones who follow the crowd. Does panic selling out of tech and running into consumer staples really strike you as the smartest move? It might appear that way, but I want to break it down even further. In this video, I'm going to explain the advantage that disciplined everyday investors like you have over everyone else, including all those MIT and Harvard MBAs running tons of funds. And more importantly, how you can build on that edge. Now, guys, we were just talking about it before the video. These titles, in full disclosure, if you're new to our channel, are created to sit there and grab your attention and bring you in to talk about something that really we want to teach. Process-driven investing, principle-driven investing. Something big is always happening in the markets. Whether it's overvaluation, undervaluation, some individual stock, there's always something great happening there. That's the perspective I want you to have. But let's start with some context first, because I think a lot of investors react to headlines without really understanding what's underneath them. Entering 2026, the market had already priced in a lot of good news. That's what historically high valuations really mean. For example, the Mag 7, the Magnificent 7, Nvidia, Microsoft, Apple, Meta, Amazon, Alphabet, and Tesla. They have run up so dramatically in recent years. Valuations were absolutely stretched out. The S&P as a whole is trading at historically elevated multiples. That was never a secret. If you've watched our channel before, you see it in every other video. When stocks are priced for perfection, it doesn't take much to disappoint. That's why you see some great companies reporting great earnings like Nvidia did last week, but still falling hard when they come out and the market opens. That's kind of perplexing, isn't it? But that's exactly what has happened. You've had a combination of forces hitting at the exact same time. Economic data has come in mixed. There are real concerns about tariffs and what they mean for corporate earnings. President Trump came out and announced new sweeping tariffs even after the Supreme Court struck down a lot of the tariffs. Consumer spending has been showing cracks for quite some time in certain areas. And on top of all that, you've got a growing fear around artificial intelligence, specifically whether the massive capital expenditures being poured into AI are actually going to pay off, and whether American AI dominance is as locked up as everyone assumes. And now, we've just started a war with Iran. The result? Investors are selling first and asking questions later. And we're getting amazing volatility. Just today, on the day we're recording this video, the market, pre-market, Nasdaq was down 2%, and we now have the Nasdaq up 0.6%. That's almost a 2.7% swing. Nvidia Corporation, which is the poster child of this AI boom, just saw its stock fall rapidly after incredible earnings report. I covered that report in our Everything Money Plus channel. From a business perspective, from a managing expectations perspective, they crushed it. Microsoft, which has spent billions of dollars integrating AI across its entire product suite, has been down. Even Amazon, which has one of the most dominant cloud businesses in the world through AWS, has pulled back tremendously. Guys, these are not broken businesses. I will repeat this until I'm absolutely blue in the face. You have to separate a business from the stock price. These stocks were in favor, and now they may be a little bit less in favor and more out of favor. That does not mean that the business has done the same thing. At the same time, banks got hit hard recently. JP Morgan, Bank of America, Goldman Sachs, all way lower. Some of that's macro. If growth slows, credit quality deteriorates, loan demand falls, banks will feel it. But some of it is also just sentiment. When investors get nervous, they sell, and they sort of sort the detail out later. Even firms like Visa, MasterCard, and American Express took major hits over recent weeks following the futuristic 2028 Centrini report that said they were heavily exposed. Now, let's talk about what's happening on the other side of this, because money doesn't just disappear when people sell tech stocks. It has to go somewhere. Right now, it's flowing into consumer staples and healthcare. Stocks like Coca-Cola, Procter & Gamble, Costco, Johnson & Johnson. These are all getting a major bid. People are treating them like safety bunkers. And look, I understand the instinct. When the market gets choppy, you want to own things that feel stable, something that everybody needs and everybody wants, even during bad times. People are always going to need toothpaste. They're always going to need basic household items. They're going to want Coca-Cola instead of beer. The revenue streams feel predictable, and predictability is comforting when everything else feels uncertain. But here's what I need you to understand, and this is really, really important. Rotating into a sector because it's going up, or rotating out of a sector because it's going down without knowing the value of what you're buying or selling is one of the most dangerous things you can do as an investor. Coca-Cola is up nearly 20% year to date, not because Coca-Cola's business is 20% or even more better, not because they suddenly found a way to grow earnings at a faster rate. It's going up because scared money is flooding in, which means the price is going up, but the value probably hasn't changed, especially in such a short period of time like 2 months. And when you're paying more for the same business, your future returns are going to go down, not up. It's simple math. But it doesn't mean it's a bad buy. But this is the trap that retail investors fall into over and over again. I don't blame you. You go on CNBC and some smart guy in an office says, well, we're rotating our customers out of tech and putting them in consumer staples. Well, okay, sounds good. They buy what's already going up because it feels safe. Then when the fear passes and tech recovers, they rotate back, buying tech after it's already back above the levels they exited or far above the levels where it bottomed. They're perpetually buying higher and selling lower, convinced the whole time they're being smart and disciplined. After all, it makes sense. Something has fear in it, something has a doubt in it, sell out of it, go to something new. But guys, it's not being smart. They're being reactionary, and being reactionary with emotion tends to be a bad mistake. I want to be direct about something. I'm not here to tell you that consumer staples are bad businesses or you shouldn't invest in them. Procter & Gamble is a phenomenal business. Johnson & Johnson is a phenomenal business. But great business does not mean automatically a great investment. The price you pay relative to the value determines your return. And right now, some of these so-called safe haven stocks are getting bid up to prices that outstrip any meaningful margin of safety and far above their value. That isn't safety. That's the illusion of safety. That's attaching a stock price to the fundamental business. Now, let's talk about artificial intelligence, because I think this is the most misunderstood part of what's driving the market right now. There are 3 distinct fears around AI that have been building since the start of the year, and I want to separate them because they are very different conversations. The first fear is DeepSeek. If you haven't been following this, here's a summary. A Chinese AI lab came out with a model that appeared to match the performance of the best American AI models at a fraction of the cost. This rattled the entire AI investment thesis. The assumption had been that American companies like Nvidia, Microsoft, Google, OpenAI had an almost insurmountable lead in AI. Massive infrastructure, hundreds of billions of dollars in capital for investment, years of head start. DeepSeek suggested that maybe, just maybe, the moat wasn't as wide as people thought. That maybe you don't need hundreds of thousands of Nvidia GPUs to build a world-class AI model. And if that's true, what does it mean for Nvidia's dominance? What does it mean for the billions that Microsoft, Amazon, and Google are spending on data centers? That, my friends, is a very legitimate question, and I'm not going to dismiss it. Competition is real. China is serious about AI. Hell, they're serious about everything, as they should be. If more efficient models mean that demand for hardware slows sooner than expected, that is a meaningful risk to the companies tied to that build-out. Nvidia specifically has priced in decades of continued dominance based on their stock price. Any crack in that story has big valuation implications. Guys, let me ask you this question. People out there, you guys know about being on time. Let's say you're leaving for a trip and you're driving from your house to 5 miles away, and you're leaving 5 minutes early. Okay, a usual 15-minute trip, you're allowing for 33% more time. Not bad. Great. Now, what if you're driving from New York City to California, and you allow that same 5 minutes of leeway? You sit there and say, Everything's going to go great. I only have 5 minutes of buffer. What's the likelihood of you being on time? Guys, what can happen at that time? Traffic, weather, broken down vehicle, getting pulled over, tons of bathroom break that wasn't necessarily. The longer out you go, the more things can happen. This is exactly why the 30-year treasury pays far more than the 90-day treasury, because over a long period of time, more can happen. You're tying up your money more. No different when we make assumptions about the future for companies. If we assume that the growth is going to be awesome for a long time, any crack in that is going to throw the entire thing off dramatically. The second fear is separate, and it's been building for longer. In fact, I've been having this conversation with Sam and Dalton, two of our in-house analysts, for months now. It's the question of return on investment. Companies like Microsoft, Amazon, and Alphabet have collectively committed to spending hundreds of billions of dollars on AI infrastructure over the next few years. The market has cheered this initially. AI is the future, spend the money, build the future, great. But now, investors are starting to ask a much harder question. When does this pay off? What does the payoff look like? What does the profit look like? What if it doesn't pay off? Because here's the reality. Capital expenditures come out of your cash flow. So when Microsoft spends $80 billion on AI infrastructure, that's $80 billion that's not coming back to you as a shareholder. That's $80 billion that needs to generate a return, ideally a very good return, to justify the investment. And right now, the AI revenue that exists is real, but still relatively small compared to the magnitude of spending. Investors are starting to wonder if the payoff is further away than the stock prices assume. And the third fear, AI will replace basically everything and everyone, or at the very least, most legacy software companies and many white-collar workers will be eradicated forever. Shares of companies like Adobe, Salesforce, Intuit, ServiceNow, which have been viewed as some of the most stable recurring revenue businesses in the world, are all of a sudden in the early stages of demise, according to a lot of the headlines I'm reading. The Centrini article amplified everyone's fears, spreading from software to financials to real estate to insurance. So the question I have to ask is, what does the data tell us is happening? Guys, AI is not brand new. This didn't begin yesterday. It's been over 3 years. It's actually been decades. We've always had some version of computer learning, but we've made a huge leap forward in the last 3 years. And most of these software companies continue to build AI into their products to improve them. In fact, in the case of a company like Adobe, demand for their product has increased since AI became center stage. So, will AI heavily disrupt these businesses? Probably, but not in the way most people think. Could it permanently eradicate this business? Maybe. It could, but at the right price with enough margin of safety, I think you'd be fine buying some of these businesses and in packages. Maybe you buy a bunch of 4, 5, 6 really large companies that make sense that people say are going to be eliminated by AI. What are the chances they all go under? Maybe it happens. Our friend Momish Parai, the channel friend who we interviewed years back, calls this a heads I win, tails I don't lose much approach. The prices have been beaten down so much that in order for them to be bad investments, every bad story has to work out almost exactly correctly. Also not as likely as every great story working out exactly. Now, I'm not telling you not to worry about AI. I'm not telling you to sit there and say, oh, if people have fears about this, they should immediately just ignore it and buy it. That's not what I'm saying. What I'm saying is ask the question, is this overblown? If something can be overblown on the good side, of course it can be overblown on the bad side. Now, I want to come back to something I touched on a little earlier because I think it deserves its own separate conversation. The danger of blindly jumping in and out of sectors or individual stocks without a clear understanding of why you bought and what the value is. Not going to lie to you guys, the level of discipline can appear boring. It absolutely is boring. It doesn't make for exciting cocktail party conversations. I've never heard anybody say to me, man, I'm so excited. I made 12% on my one individual stock last year. Nobody ever says that. They say, my stock doubled. My stock did 40, 50%. No one talks about ho-hum 12 or 13%. But guys, if your portfolio did 12 or 13% a year for 30 or 40 years, you'd be one of the best investors ever. And that's how wealth is built over time. I've been in the world of investing for over 30 years now. I've seen this exact pattern play out in 2008, 2020, and just in stocks, in every major drawdown in between, also in 2000. The investors who come out ahead were not the ones who were the most active and made the most changes when they felt fearful. They're the ones who understood what they owned, had conviction in their own process, and didn't let, this is most important, did not let short-term fear override long-term thinking. I promise you that most people who own Meta at 320 or 240, even 180, probably sold when they were down significantly on their position. I get it. It's terrifying when that happens, especially when the news follows the stock price. And the news is saying how Zuckerberg's an idiot, Meta is going to nothing, it's a terrible investment, yada, yada, yada. But when you're able to recognize that price is far below value and you're able to patiently wait, here's what's crazy. As of today, even the shares at the high range of 320 would be up over double and giving you a 15% annualized return, watching it go from 320 down to 88 and back to where it's at today. So if you're buying at 300 because you believed it was undervalued, everyone you may have told would think you were wrong because it went from 300 to 88. Guys, I heard it. I started buying, I don't remember the exact price was, 200, all the way down, and I got lucky and bought it on the lowest day ever of 88. And the entire time people were saying, see how wrong you were about Meta. I was like, maybe, but guess what? Just like somebody now saying, look, Paul was right about Meta, maybe, I'm gonna know years from now what I was right about. This is why our process always starts with the fundamental business, not the price chart, not sector rotation, not what CNBC is saying today. Answer simple questions about the actual business, and you'll never have to worry about whether you need to rotate into consumer staples because the market's down in February. And when the market's down in January and February, it means that 87.4% of the time, the year is blah, 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 blah. Guys, I'm going to say one more thing on this. The financial media is stupid, and they have a business model that's built on your anxiety. I'm here on YouTube. We get your attention with anxiety-driving titles and thumbnails. That's a fact. That is absolutely a fact. And we talk about it in-house, how we hate the fact we have to play the YouTube game. But we also look at it and say, if we play that game though, we will catch some people who go, wait a second, this makes sense. What this guy is saying makes sense. And then we have to be able to make them realize there's another way. Calm doesn't generate advertising revenue. Fear does. So the incentive of every financial news outlet, every headline, every breaking alert on your phone is to make you feel like you need to do something right now, today, before it's too late. Understand that dynamic and you'll start to see the noise for what it is. Most of the time, the right move is to do nothing, to sit on your hands, to let the process work. It's not exciting, but guess what, guys? Would you rather be excited every day and poorer or bored but a lot wealthier? That's the question I have for you. This is exactly why I teach on YouTube. Because I see all these people jumping in and out. I hear friends saying, oh, this is the greatest thing. And then when the stock falls, oh, this thing sucks. Guys, I have a principle-driven approach to investing. I have 5 tenets that I live by. Whether it's buying a business, a stock, which is still a business, a piece of real estate, or anything I'm looking at, I think about these 5 things. 1, I'm an investor, not a speculator. 2, every investment I make is going to be the present value of all the future cash flow it receives. 3, if I don't understand it, I don't invest in it. 4, in the short run, the stock market's a voting machine. In the long run, it's a weighing machine. And the 5th and most important one, a great story becomes a bad investment if you pay the wrong price. The problem is most people don't believe that. Most people believe you have to have a great story to make good money. To which I always tell people the blue chip stamp story from Munger and Buffett. They bought a business that was doing $120 million in revenue in the early 70s. 12, 13 years later, it did $100,000 in revenue, a 99.9% drop. They still made 15% return on their money. Why? Because they paid the right price and they understood what they were buying. So guys, if that principle-driven approach makes sense to you, or at least gets you going, what is this all about? Click the link below. I made it very simple and easy for you. I created a cheat sheet. It's a PDF. It'll be sent to you right away. Click the link, get the PDF, keep it handy, read it daily, especially read it when the markets are causing you fear. We know that tech stocks have been falling this year. Amazon, Meta, Microsoft, these are not bad businesses. In many cases, they're extraordinary businesses. Even Adobe and Intuit, they have dominant market positions, massive free cash flow, incredibly strong balance sheets, and they're at the center of what is arguably the most significant technological shift in a generation. The problem has never been the business. The problem is always the stock price. News follows the stock price. When the stock price is down, the news justifies that after. When the stock price is up, the news justifies it after. But here's what I want you to hold on to. There will be a day. I don't know if it's this month, 6 months from now, forever. I don't know when. But when these stocks have come down enough, when the earnings have grown, when the valuations have compressed, there will be a time when they become some of the most compelling opportunities in the market. In 2012, I was buying Microsoft at 8 times earnings. I was told by his tech CEO how it was a dead company, even though I said to him, but their revenue and profits growing 7 to 12% a year. He said, I don't care. It's a dying business. Imagine being told that you were dying. You were 50 years old, you were dying, and you had the healthiest result in the world from your doctor. And getting better every year. You were healthier at 50 than 45 than 40, and you were told you were dying. That was the same thing. This is when our process will kick into place, when we're going to see what others say and then understand what we see fundamentally. We've gone through this with Amazon. AWS is one of the most dominant businesses ever built. E-commerce has a moat that's almost impossible to replicate. But for a long time, the stock price didn't give you any room for error. Then there were periods during the 2022 sell-off, for example, when the price got interesting. The business didn't change, the price did. If you paid an expensive price for Amazon 5 years ago, you only saw about 5% returns annually. If you paid a lower price relative to value in 2022, you'd have seen a 35% annualized return even after recent pullbacks. What's the difference? Price paid. That's the game. That's what we're waiting for with a company like Nvidia. That's what we're waiting for with Microsoft. We're not just blindly hoping these companies fail. We're hoping their stock prices come down to a level where the math makes sense. Now, you're probably thinking to yourself, Paul, those stocks aren't going to fall like that. If I had $1 for every time I heard that, I wouldn't need a YouTube channel. Guys, no company ever stays in favor forever. Eventually, there's a time when everybody thinks the 90s was Microsoft and Dell. By 2012, Microsoft was considered dead, and Dell had to go private to go say, we're going to recoup, grow our business, and then go public again. They needed a reset from the market. Guys, in the meantime, we're not going to chase consumer staples that are getting artificially inflated by fear. And we're not going to sell great businesses at low prices just because the market's nervous. In fact, I wouldn't even sell a great business at a high price if I believed in it long-term and I've been an owner for a long time. Patient capital wins. And the investors are sitting on their hands right now, doing their homework, understanding what things are worth and waiting for the price to come to them. Those are the investors who are going to look back at 2026 and say, that was an opportunity. If you're scared of losing money in the market, I know why. You've probably been guessing. And I used to do the exact same thing. I would buy stocks because someone on TV said that they're going to the moon. But that's not investing. That's rolling the dice. And that's exactly why I built Everything Money. First, it was built for me. I wanted the tools that gave me clarity and helped take the fear out of investing. People saw me using them on YouTube and said, Paul, how do I get that software? And I used to joke and say, you can't, it's a big data feed. But then it dawned on me, no, I can make this for other people. So I did. And a real community of people who agreed to grow together was born. Real people sharing ideas, live chats, live streams, and tools that help you be better than 99% of investors out there. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator, and Retirement Calculator. So stop guessing, start learning, try it for $7 for 7 days, and see how your confidence will replace fear. Click the link on your screen or go to everythingmoney.com. So let me bring this all together right now. Tech is down, software especially. AI fears around disruption, DeepSeek, and whether the massive capital spending will pay off are rattling investors. And in response, money is starting to flow and flood into consumer staples like it's 2008 again. Here's what I need you to take away from today. None of that changes the process. The process is the same in a raging bull market as it is in a bear market or a flat market. What is the business doing? Will it be around for the foreseeable future, 10, 20, 30 years? Will they be making more money or less money down that line? And most importantly, can I pay a reasonable price today that gives me an adequate return on my capital based on that future, I presume? If you could answer those questions about any stock, whether it's tech, consumer staples, healthcare, home builders, tobacco, anything, you'll never have to react to what the market's doing on any given day, besides decide if you're a buyer or seller on other people's fears or euphoria. You're going to have the conviction. You'll know when you're ready to buy and when you're ready to wait. And you'll not be one of those investors who is perpetually buying what just went up and selling what just went down. Those are speculators. The fear right now is real. The uncertainty is real, but uncertainty is not the enemy of an investor who understands what a stock is inherently worth. Uncertainty is the friend of that investor because uncertainty is what creates the prices that eventually become opportunities. But the key is you gotta be patient. You gotta do the work, do your own research, and don't let a scary start to the year convince you to make a decision you're gonna regret by the end of the year. Now, if you wanna see our entire detailed process, I've put together a video just for you. One where I explain each step, how to understand a business, its financials, what key metrics I look at, and how to use our stock analyzer tool to determine the right price today. So if you want to check it out, click the video on your screen. Thank you for your time.